We're joined now by Peter Churchouse, Director of LIM Advisors, for his 2005 Asian Market Outlook. Peter joins us from our Hong Kong studios. Peter, thanks a lot for joining us again on the show.
Good morning.
If we look at the lessons of Thailand, will the hares of this year become the tortoises next year and vice versa?
Well, that's certainly been the history of Asian markets over many years, is that certainly Thailand was the hare of last year's markets and has been very much the tortoise of this year's. It's been the worst performing market this year. India also has been a very so-so performer. So it's been very much the markets this year that have done well have been generally Southeast Asia, and Northeast Asia has done less well. So maybe there will be a bit of a switch next year where we may well see markets like India reverse its positioning in the league tables here. This market is growing at about 12% and trading at just over 11.5 times earnings. The valuations look quite compelling, and in a region where earnings are going to drop to well below 10% in the broader Asian region, to have a market that's growing at around 11, 12, 13% is probably quite comforting.
Peter, what about the markets that have been hovering around the middle of this table, such as Malaysia? Yesterday we were speaking with Charles Wheeler of S&P, who was just giving us his thoughts on Japan and Korea, who believes that the growth potential for Malaysia is much higher now under the current administration. What's your thought on Malaysia?
I would agree with that entirely. Malaysia's been quite a good performer this year, about 18 or 19% up this year. But again, it's one of the countries which has, I think, a decent valuation and, again, earnings growth around 12 or 13%. And what I think is more important to investors is what's going on at the macro scene in the political and that sort of area, where I think we see the new leadership is much more what I might say investor-friendly. We're likely to see potentially the easing of foreign currency controls, so I think that's going to be very positive for Malaysia. I think also there's plenty of scope for domestic consumption growth in Malaysia as well. So I'm pretty positive about the prospects for Malaysia next year.
Peter, just picking up on your issue about the relaxing of foreign currency controls, how great a risk to Asian markets is the weakening US dollar story, therefore by default the strengthening Asian currency story?
Well, the weakening US dollar is a bit of sweet and sour. Obviously, Asia doesn't necessarily do too badly from a weaker US dollar. It makes Asian exports generally competitive to non-US dollar countries such as Europe and Japan. However, the danger is that we go into a US dollar crash here, and the world does not want to see a US dollar crash. This is bad for everybody. So a gentle weakening over a period of time is not necessarily bad for Asia, but a sharp downturn which takes perhaps the dollar to 85 in the yen or 145 on the euro is really bad news for the global economy, and that's the last thing we want to see.
Sure is. Peter, do stay with us. We'll be taking a closer look at the Hong Kong property market after this. Real estate is rebounding, paving the way for the territory's first ever real estate investment trust, or REIT. We'll have more of that in 2. The good times could be here again for Hong Kong's property sector. After a 6-year slump, prices in the territory are rebounding. Given the turnaround, the Hong Kong Housing Authority is launching a massive real estate investment trust, or REIT, the first to be traded in Hong Kong. Link REIT makes its debut on the Hong Kong market on December the 16th. The property trust is likely to raise up to 30 billion Hong Kong dollars. Well, for more on the outlook for REITs in Hong Kong and around the region, let's get back to Peter Churchouse, Director at LIM Advisors, live from our Hong Kong studios. First of all, let's just talk about this Hong Kong Housing Authority REIT. How good do you think the fundamentals are of this particular property trust?
Well, I think there are 2 issues to look at here. Firstly, how it will be received by the market, and secondly, how the company will function over the longer term. I think initially the market will receive this very favorably indeed. It looks to be coming at about a yield of 6.8%. It will be an extremely large IPO. It will be the largest IPO the world has ever seen in the property sector. It will be about 150 to 200% bigger than the previous biggest property sector IPO. So there's a lot of paper coming to the market, but I think it will be well received initially.
Peter, Philip in Hong Kong here. Some more details on this particular REIT. 150 different shopping centers, 79,000 parking spaces. But we talked a bit about this earlier before we went on the air, and one of the issues was perhaps execution risk from the management standpoint. Some of these buildings are significantly older. They need a tremendous amount of maintenance. The Hong Kong government is going to be putting some money into this, but essentially it'll be managed by an entirely new group of management people who may or may not have the necessary experience to deal with these tenants that have been there for so many years.
Well, yes, that's right, Philip. I think there are a couple of issues here. Firstly, this is far from prime grade A real estate. This is pretty basic kind of stuff. It doesn't compete really with the private sector. It's pretty low quality real estate if you look at it in a regional or a global scale. However, it has got a very big and powerful population catchment. About 40% of Hong Kong's population are in the catchment of these estates. The big issue here, as you say, is execution risk, in my view. These tenants have been mollycoddled for many, many years by the government. They have never had to pay commercial rents. They have never been properly managed as estates. It's been run under government rules and government regulations, which are way, way outdated. It has not been run as a fully commercial, operational procedure ever. So the big challenge for the new operators and the new managers is to bring this into the 21st century and make it commercial, make the tenants pay proper commercial rents, upgrade the facilities, upgrade the tenant mix. It's a total mess at the moment, so there is potential upside if the managers can achieve these objectives.
But Peter, let me follow up on that. What is the risk then to the yield? The yield's expected right now 6.7 to 6.9%. Also, you have to worry about the principal of the value of the REIT as well. How much risk is there in this particular REIT?
I don't think there's a lot of downside risk in the earnings in the short term, for the simple reason that these leases are already set, they're cast in stone. What I'm concerned about is the risk to the upside, also the political risk. The tenants in these housing estates have already banded together and are approaching the Legislative Council to assist them in ensuring that they get favorable treatment, they get their social rents, if you like, maintained over the long term. I think this is just totally untenable, and there's a very strong risk here that the politicians will side with the tenants in these housing estates and force the manager from being fully commercial in the medium to long term. That, to me, is a significant risk.
Peter, how do the Hong Kong REITs compare with Singapore REITs, especially as we've got a big Suntec REIT coming up?
Well, this is the first REIT in Hong Kong, so we don't really know what the comparison is going to be like. It's certainly way bigger than any of the Singapore REITs. The Singapore REITs actually have proven to be extremely successful investment vehicles since they were listed a couple of years ago. They've performed very, very well. They have had very low volatility. Share prices are up. Yields have come down. Investors love these things. So they've done very, very well in Singapore. I suspect, actually, Suntec may actually compete a little bit here with the Hong Kong REIT, and perhaps it'll be competing for investors, particularly at the global level, and I think perhaps they may struggle to find as much favor amongst the international investors as the Hong Kong REIT may do. But bear in mind, the Suntec REIT in Singapore is actually owned by Hong Kong developers.
Interesting point to make. Peter, thank you very much for joining us. Peter Churchouse with LIM Advisors in Hong Kong.